there is so much going on. We have a new a new disease process that they're shoving down our throats. You almost can't get away from it. Turn on the mainstream propaganda ministries and they're fist feeding you monkeypox. The resurgence of COVID. Now we have, this whole thing going on. Imagine my shock here. And we know the mechanism: crisis to crisis to crisis. More fear, more anxiety, and people, I think, are being pushed to a breaking point by design. You all know that. I mean, it just couldn't be more evident to me. Now, with regard to this market, and that's what this is all about, we don't have to guess. You and I do not have to guess as to where this market is going to go. You already understand the key. The key to this is the debt market. More specifically, again, I'm going to repeat it, it's the 10-year yield. Look at how this has played out. By observing one dynamic that I have covered at length to the point of nauseum for years and years, you and I have a very good idea as to where this market is going to go. We have a 10-year yield today at 2.79. That is from Friday's close. Okay. What can we gain by looking at this 10-year yield? If we see cash leaving the debt market, and we can observe this very simply, watching the 10-year yield. If cash is leaving the debt market, the 10-year yield is going to rise. Where is the most likely place where that cash is going to go if cash leaves the debt market? It's going to go into the stock market. Period. That's where it's going to go. Well, again, it's very simple. If we realize the flow of money, where cash is moving, if we see that 10-year yield rise, we know equities are going to move higher. Let's take the opposite side of that. If you see the 10-year yield drop further, a lot of fear in this market is pulling cash out of the stock market. It's going into the safety, I laugh every time I say that, of debt. Well, the stock market's going to fall further. On Friday, we've had volatility in this market that could make your head spin around like The Exorcist. There's no doubt about it here. The Dow Jones Industrial Average on Friday was down about 600 points. We recovered all of that after the S&P 500 fell into, by definition, a bear market. We came out of that. It's just crazy, the ride in this market. But again, just gauging from action in the debt market, you and I do not have to guess as to what's going to happen with this market. What also happened last week, we got some pretty stark warnings from big retail. You got Walmart and Target. We've been fist-fed the bullshit and dog shit and cat shit for I don't know how long. Our economy is strong. The consumer is doing great. Oh, really? No, doesn't seem like that according to big retail. And that's another thing. We're going to hear from more big retailers this week, and we're going to see how that affects the market. But again, what are you going to do? You're not going to sit here and focus on the stock market. No, you're going to look at the 10-year yield. Let's say, for example, okay, let's just throw this out as a hypothetical. The S&P 500 falls into bear market. I know it feels like a bear market, and the NASDAQ is in bear market territory, no doubt about it. The S&P 500 and the Dow remain in a technical correction. Sure as hell feels like a bear market. We all know that. But I'm just going by the textbook here. If, in fact, the S&P 500 falls or closes below, let me show you, 38.20, that's our number. All right, 38, 37, 25. If we close below that number, what does it mean? There's a lot of talk. People don't understand it. Let's just talk generalities here. A bear market in the S&P 500 would, if we look back on history, mean we could expect a 30% drop, around 30% drop from the all-time high with regard to the S&P 500. And how long do these things generally last? Roughly 13 months. Okay, so what would that mean? I mean, generally speaking here, after that, I think there would be a lot of opportunity to be very selective here. Okay, you can't just, you see, before this, when we had this market that did nothing but go straight up, since basically the last meltdown, 2008, you could have bought anything. You could have thrown your money into anything and it would have gone up with regard to if you had bought stock in any company. Now we got to be more selective here. I still believe firmly you need to own oil and gas. ExxonMobil, CVX, DVN, any one of these would be a good choice if you want to buy stock in a company here. You also get paid a nice dividend. You need exposure to commodities. I don't know how to say this another way. You can use many different ETFs, or exchange traded funds. My suggestion has been PDBC. The performance of PDBC since I recommended it has been freaking stellar. I own it. Doesn't mean you need to, people. I want you to do your own research as always. But in my opinion, in this environment, you need exposure to commodities. You need to be betting against the debt, becoming your own central bank here, owning hard assets. You know, what's my favorite of all time? Exactly. Physical silver. Gold. I love gold. I love platinum and palladium too. And yes, people, I am not going to waver from this. I personally believe, and you're entitled to believe whatever you want, but I believe you need exposure to cryptocurrencies here. Yes, they have taken quite a hit lately, but if there's one thing you should know about the crypto space, if you've been following it for since the inception, is extreme volatility. Nor is that a surprise to anybody here. Extreme volatility in the crypto space is something I said would happen this year. At my wrap-up at the end of last year, and stock market volatility, same kind of thing. Anyway, look, I'm not saying that this is the most lovely environment to be in. It certainly isn't. But as people who are speculators in any asset, in anything, if you're putting your cash to work in, whether it's real estate, whether it's the stock market, whether it's in precious metals, whatever, you got to expect this. Generally, investing is something that takes time to play out. You understand? I think you do. And people, everybody wants that instant fix. You know, you want that shot of heroin. You want that high. But unfortunately, there are times where you got to sit through what we are right now. And to me, looking at the market that has done nothing but gone pretty much straight up since 2008, and now we're getting this rout in the market, okay, whatever. You got to be able to get through this. And again, what's the key? What do we start off with here? The 10-year yield. The 10-year yield must rise. It must close and eventually settle above 3% for this market to make any kind of meaningful gains in this environment. The market has been pricing in rate hikes. You know that. So that means the 10-year yield must adjust. You understand? It's very simple. You know, cause, effect. Cause, effect. That's the market. Also, fear and greed. Fear and greed. Fear is stronger. I think you understand that. All right. So this week, just real quick, we're going to hear from more retailers. That's going to set the tone a lot. But look, it's not forward guidance. It's not PE ratios. It's not anything like that anymore. It's all about watching action in the debt market. The debt market is the biggest rigged game in history, more so than even precious metals. And precious metals is rigged to the highest order. It's the debt market that central banks have chosen to manipulate because that's all they can do. Again, all the tools, that we hear Fed Chair Powell talk about, he has one tool, and that is the manipulation of debt. And believe me, they did not miss their 2% target by exponents by accident here. And now, again, it's like, oh, yeah, our president retard. Oh, I'm sure the Federal Reserve is going to do the right thing. Oh, really? How about no? And no one's going to be held to account for a damn thing. So anyway, let me just make sure I covered what I want. I told you about retail. I told you about the 10-year yield. Keep your eyes on it. We got to get above 3. There's no guesswork. Stop guessing at what the market's going to do, what you think it's going to do. Just watch the 10-year yield, and you're going to be able to know. If you see the 10-year yield drop, it's at 2.79, you know this market's going to not like it. That means cash is coming out of it, going into the safety of debt. If you see the 10-year yield rise, that means cash is leaving the debt market. It's going to make its way into the stock market, period. That's where it's going. Anyway, let us move forward here a little bit. I told you about commodities, people. Look, please do your own research here. I've explained to people forever that we are eventually going to get an implosion in that debt market, which is going to melt down the stock market. What we're seeing now is like laughable compared to what's eventually going to happen with the implosion of the debt market. It's going to melt down the stock market. Cash is going to move. It's going to move in a tsunami. That's the word I've used forever now, into commodities. That's why I believe we could be in the early stages of what a lot of people are saying is a commodity super cycle. Yeah, I think that's going to happen. I really, really do. I also believe cryptocurrency's market cap overall is going to balloon, and that is going to be very positive for cryptocurrencies. I have no intention of selling any of the cryptocurrencies that I currently hold. I own 7 different cryptocurrencies at this time. If you are a subscriber to my newsletter, link in the description of this lovely video, you know exactly what these are. I put out 2 twice. I said, these are the cryptocurrencies I own, from my greatest exposure, which would be Bitcoin, to all of the rest. So if you're curious, go check your inbox with regard to oil. Go look at my newsletter here. I explained to you how these bear markets generally play out. If we close, if this market, people, S&P 500 closes below that number, that would be the definition of a bear market. So what could you expect? Again, around a 30% sell-off from the all-time high, and a length of about 13 months. So, but again, look, there is still, and I want you to understand, the great possibility that all of this is going to turn around rapidly. If you're a technician here and you're looking at stock charts, you have to say that it looks like it's very possible that we could see a rip-roaring rally. I think one that is going to make people's heads spin around again, like The Exorcist. I like to say that. With regard to this market, and it all depends on action in the debt market, people. I'm not going to repeat this again in this particular video. All right, I already covered it at length. So, but you know the key. You know the key. So stop guessing. Make sense? All right, look. So it is Sunday here. I hope all of you have a great day. Ponder the things I have spoken about here. Does this make sense to you? Do you believe that you should have exposure to commodities now or not? Do you believe that you should continue to bet against the debt, become your own central bank, understanding that global debt is going to balloon from here? And I mean balloon. Debts and deficits are out of control, and it's not going to stop. So what do you want to do? What do you want to do? Think about it. How should you attack this situation with regard to the market? If you are so inclined, I still think you need exposure here. Like I said, oil and gas producers would be a big one. Consumer staples here. Check my website, traderschoice.net. Look at my stock picks. I think these are places that you need to be in. Financials have gotten hit pretty damn hard. I think there's a lot of deals to be made. I really, really do.